Good morning, everybody, and welcome to this Market Vision 2020 mini-series event, Introduction to the Wyckoff Method. Bruce Fraser, stock market strategist with the High Growth Income newsletter, is here joining us today. First of all, welcome, Bruce. Always great to have you join us.
Oh, gosh, it's great to be here. So
yeah, and again, I was just talking a couple minutes ago about, some of the things that are included in the newsletter. And I thought before we got into all of this, I just wanted to point out that I had no idea that you were a mechanic for an auto racing team. When was that? And what team?
Well, that was in my younger days. I was in my teens and 20s. I was just all things motorhead. I was a mechanic, and then also I worked for Auto Week, which was at the time, I think it still is the premier auto. At the time, it was the premier auto racing weekly newspaper in the country. Mm-hmm. And so I worked in the editorial offices, and so I did a lot of crazy stuff for them, which was really fun. And then also, and did a lot of auto restoration work and mechanical work, and then that led me to working on a racing team. So
is that still a hobby of yours? I mean, do you still like to restore cars and work on cars?
Yeah, I like to work. I like to be really more of a backyard mechanic, and I work on old cars and old motorcycles. I probably have done more with old motorcycles than cars in recent years, and but I don't have a lot of time for it. So yeah. I'm hoping to make more time for it.
Well, everything's coming a lot clearer for me now because you worked on cars as a mechanic, kind of got under the hood, seeing what was going on, and now I understand that you do the exact same thing in the stock market. You kind of get under the hood of the market and some of the areas, and what's taking place, the back and forth, the consolidation, then you come up with these projections and all. So I know what's that?
I like that. I like that analogy.
Yeah, I mean, You're kind of digging in. You're digging into the market, which is pretty cool.
Well,
but we're going to get started here in 1 minute.
Today.
Yes. I want to just let everybody know, if you're unfamiliar, if you haven't heard from Bruce in the past, he is an industry-leading Wyckoffian. He began teaching graduate-level courses at Golden Gate University in 1987. I don't want to date you, Bruce, but that's over 3 decades ago. He worked closely with the late Dr. Henry Pruden. He developed curriculum for and taught many courses in Golden Gate University's Technical Market Analysis Graduate Certificate Program, including technical analysis of security, strategy and implementation, business cycle analysis, and the Wyckoff Method. For nearly 3 decades, he co-taught Wyckoff Method courses with Dr. Pruden and has also used this approach to the markets as a foundation of his own trading for over 35 years. A couple of things, I'm going to have Bruce get right into this, but a couple of things just to mention. There was not a poll question for Bruce in the newsletter this morning, and instead we had a general survey question, which all of the speakers are going to be answering rapid fire on Saturday, January 4th at the end of their presentation. So if you go in and you answer those poll questions, you'll be able to come back into the presentation on January 4th and hear all of our answers to those questions as well. So you can kind of see where you fit in terms of what all the speakers are thinking in terms of those questions. So make sure you go back and take a look at that. As far as questions and answers, if we get a number of them and we can't get to them today, Bruce has already said that he would be happy to respond to those questions via email, but I will be looking for the questions as they come through. And if I can get through, and ask those questions to Bruce, we'll try to get those answered here in the session. Again, this is being recorded. So if you, for whatever reason, need to leave and you can't stay till the end, don't worry about it. We've got you covered. We will be posting this event, this recording, to our EarningsBeats YouTube channel, probably within 2 to 3 hours of the close of the session. So if we're done within an hour, say by noon, you should see it up by 2 or 3 o'clock Eastern. So you can always check that out. But again, Bruce, really, it's a pleasure for us to have you come on board and join us here for this mini-series event, and also to present at the Market Vision 2020. Bruce has been such a great friend of mine over the past few years. One of the nicest gentlemen I've ever met. And again, just really happy that you could join us today. So I'm going to let you take over and get started. What do you have for us today?
Well, thank you, Tom. That was a very nice introduction. And this is about the most fun I can have, is to just talk about Wyckoff and the Wyckoff Method. And as you can imagine, I've been teaching these classes for, gosh, over 25 years. And these were actually graduate level courses that we did in the Wyckoff Method. So what we're going to do today, in the little bit of time that we have, is we're going to summarize something that would take us 15 weeks, 3 hours a week of class time to relay this methodology. And we did this for 3 semesters. So I did 2 semesters, and then Hank had another third semester course that he did that was sort of a fusion course with Elliott Wave, and a lot of fun though. So, but the goal here today is to introduce you to the Wyckoff Method. I'm going to try to point you to some more resources so that if you're really interested in what we talk about today, you can go on and look for more materials. And then also keep in mind that when I do my Market Vision 2020 talk, which is going to be looking at the year ahead, the methods and the techniques that we talk about today are the ones that I'm going to use for that talk. And so, and I'll dig in a little bit to that as we go along here today. So I'm going to try to take the screen now.
All right. Yeah, it's really interesting. You've been on some of the shows that I've done in the past over on Stock Charts TV, Market Watchers Live, and so forth. And I'm always fascinated watching what you do with Wyckoff, because I think my style is a little Wyckoffian. I mean, I never studied it, but when I watch what you do in terms of the consolidation periods and, the reaccumulation or the redistribution or, distribution, whatever, I kind of take that same approach that you all do, and some of these false breakdowns and false breakouts and things like that. So I think that there are a lot of folks, even though they may not have studied Wyckoff, may look at what you present and realize that they got a little bit of Wyckoffian in them.
Oh, and we've had so much fun together talking about this. As a matter of fact, I put a chart up in this presentation today just for us, Tom. And so you'll recognize it as we go. And it really is just best practices. And I think if there's anything that we can learn from this methodology that was developed over 100 years ago, is that there's some unique capabilities in Wyckoff in how to develop higher levels of mastery in chart reading. And so we're going to work on that today, and I'm going to at least introduce the concept, and then hopefully what this does is it helps to elevate our chart reading skills to another level, because there's a whole another world in market analysis that comes, from Wyckoff and from others and from best practices that I think will be eye-opening to some people. So anyway, with that in mind, can you see my screen okay here?
Yes, you're up and you're ready to go.
Cool. And I put this email address here because Mary Ellen McGonigal and I have started, or are in the process of starting, this newsletter that's oriented towards identifying stocks for ownership that have great growth potential, but also have good dividend yields. And so it's a combination total return concept that we think is very dynamic. And so if you would like to be on our list and be notified when we're ready to publish this letter, please send me just a request to be on that list. Okay, with that in mind, this is what we're going to do today. We're going to do a workshop. It's going to be very informal. So it's like, I want to treat this like we're in the classroom together, and so just sort of chat about it. And we're going to do two big things. We're going to talk about accumulation studies, chart reading accumulation characteristics, and we're going to do an introduction to point and figure. So that's a lot to do in the time that we have available to us. So I apologize if I go quickly, but the idea is to point you to resources where you can further develop your knowledge about this. So I think of Wyckoff as a campaigning methodology for its identifying stocks or indexes that are ready to go into important uptrends that are going to last some period of time. And so let's just start this whole thing by reading the words of the great Richard D. Wyckoff. And he says, there are many men, and we would include today, we'd say many men and women in Wall Street and throughout the country who make a practice of taking profits in accordance with their ideas of proportion. Something like this. They say 50 points is a big profit, even if it is on a small lot of stock. Therefore, I will take it. Others will say to themselves, I have a profit of 100% on my investment, and that's good enough. I will let someone else have the rest. In the case of American Graphophone, this gives you an idea how old this is, I followed a different rule. The number of points or the percentage of profit did not influence me. The fluctuations were interesting, but whether the stock went up or down, I decided to wait for it to reach a certain point before I would take profits. This meant the point where the insiders began to sell. And this is the art of the campaign, which is what Richard D. Wyckoff called tape reading. And so you can see the tape over there on the left. Well, he saw tape reading as being chart reading. And so he wanted to see the footprints of the important operators, what he called the insiders, but he also called them the composite operator. And we're going to talk a little bit about that because the composite operator is the one, and I'll explain more about this, who puts the footprints on the charts that we can follow that help us to tell what their intentions are, what they're going to be doing. And this is very important and very exciting. And so here we have the Wyckoff price cycle. So we have this accumulation area. So this is a classic cycle from going from a trough, an oversold trough, to an overbought extreme, and then back again. And the market is just the endless process of doing this over and over again. I had CNBC on this morning, and they had these analysts, and they were so excited about the year and how well it went and what 2020 holds and all that. And if anything, and you can go back and look at my videos from the last few weeks where I go through the analysis we did in the year 2019. I look back and you could see extreme oversold conditions at the end of 2018. And now we have measurably, using point and figure, extreme overbought conditions. So does that mean the market has to go down? Not at all. But and this is what we're going to talk about in Market Vision 2020 in the outlook for the next year. But we would have to say that the market is overbought and that it's reaching overbought conditions. And so there's a way to determine this. So we want to be measured, and we want to think in terms of the cyclicality of markets and not get caught up in the extreme psychology of deep troughs and extreme overbought conditions. So here we can see the oversold condition, which produces an accumulation area. This is a point of value in the market where the composite operator, the very, very large operators that control meaningful amounts of money, that buy enough stock that they actually influence the chart. And it's not one person. The composite operator is a number of these large operators, all acting roughly in the same way at the same time, not knowing what the other ones are doing. And that's why Wyckoff called them the composite operator, because it's a composite of many different forces at work thinking the same thoughts at the same time. Warren Buffett cannot buy stock the way that we buy stock. Warren Buffett has to be very methodical. It takes him months and months to build a position in a company that's large enough to be meaningful in his portfolio. And contrary, when Warren Buffett decides seldomly to sell a stock, but he's done it, he wants to do it in that overbought area where he can sell his stock over many, many weeks to months, carefully, methodically, so he doesn't put the price of the stock down on himself. And if any other big composite operator gets wind that Warren Buffett is selling stock up there, they're going to be doing the same thing. So these people are all in competition with each other, and they just have to function differently than the public functions. And this is what makes them the best at what they do. There's composite operators that are institutions, probably most of them, but there are also institutions that are not composite operators. So we don't want to confuse them. The composite operator is a style, it's an approach that makes them so good at what they do. And we can see some of them out there, people like Stanley Druckenmiller, and there are many others, and they're all operating uniquely and apart from the others that are also competing with them to build these big positions. So with that in mind, we want to ride along with the composite operator. We want to buy when they're buying. Let me see if I can get my little pen going here. So we want to be buying at the time that the stock has reached a condition where it's ready to go into a big markup. And then we will be selling when the composite operator is selling their positions, which could be months to years later. And so this is the Wyckoff method in a nutshell. Okay, so now let's go on. So this is that trough area. This is primarily what we're going to talk about today, but there's other attributes here that we can't really get to today. And that is, here is the accumulation schematic for two types of accumulation structures. Now, what we're interested in is we're interested in the behavior of prices as they go through this accumulation area. We're looking at how prices change their behavior to tell us how far along we are in the maturity of the accumulation phase when it's getting ready to go into markup. And I'm going to show you an example of that. So here, what stops a downtrend, as we saw, that what precedes accumulation is a big downtrend. Well, downtrends occur because stock is in weak hands. When the composite operator types no longer are campaigning and supporting a stock, they distribute their stock to others because they no longer want to own it, and these others tend to be weak holders of the stock. That is what produces a downtrend in a stock, is weak holders. And so we part of our Wyckoff methodology skills is to not be to be owning these stocks when they're in weak hands. We want to only own them when they're in strong hands. So we can see this downtrend going on, which ends with this climactic surge called a selling climax. A classic example of a selling climax was the decline into December 24th of 2018. And so go back and study that, because the volatility is eye-watering. It is just the volatility that you get into a selling climax, and there's many of them through history in individual stocks and indexes, is incredible in many cases. But the selling climax produces a condition where there's undervaluation in the stock or the index to the point where large interests will start to want to buy value, and their buying value actually puts a support level under the market. And so what we see is we see a selling climax and we see an automatic rally. These are Wyckoffian terms, and we label our charts with these because it helps us to understand how prices are evolving over the course of the accumulation structure. So selling climax, automatic rally. As soon as we see that, the first thing we do is under the low of the selling climax, we draw a support line, and we draw it out into the future, not having seen the rest of the price structure because that's ahead of us in time. And above the high price point of the automatic rally, we draw a resistance line. And so we can see here that this more or less is the boundaries of trading for this instrument before it concludes it may be in redistribution for another decline, but if it's in under accumulation, it'll show characteristics that will show that the stock is ready to turn up and go into a new uptrend at some point in the future, which could be months later, months to a year or two later. So, but think of how valuable it is to just have this information that once you have a selling climax and an automatic rally, you draw resistance and support lines, which are going to bound prices for some number of months into the future. That's remarkably valuable. So then what happens is that we define phases. We have phase A, phase B, phase C, phase D, phase E. And we identify the different phases of accumulation based on the relationship of price and how price is behaving to how volume is behaving. And we look at these and we make judgments about when a phase is ending and a new phase is beginning. Phase A is the stopping of a downtrend with a selling climax and an automatic rally. Those are the 2 points that tell us that phase A is in. Then once you get a secondary test, you go into phase B. Phase B is the wild, wild west. Phase B, and this is not to be traded by most Wyckoffians, is that phase B is just this wild and woolly trading range. And the reason it's so wild and woolly is because stock's in weak hands. And I'm going to explain to you in a minute what's going on, how stock is changing hands from weak to strong. And as stock changes hands from weak to strong as accumulation proceeds, it causes the character of price to change as this is going on. So price behaves differently, but it takes a trained eye to see it. So here we see in phase B that there's just these wicked declines, wicked advances back and forth over time. And this can go on and on and on. And this is why Wyckoff is not pattern recognition like other forms of technical analysis. It's behavioral recognition. So then what happens is that you can see here, just as an example in the schematic, this decline from here to here is sharp, quick, and also you can't see it, but there's a lot of volume. A lot of volume kicks off the decline, demonstrates supply is present. Then here you have another one. You get back to resistance and you come down. Well, look at the difference between the first decline and the second decline. Second decline took a lot longer. And the other thing that happens is that the volume that comes in that produces the supply and the decline is high, but it diminishes. So let's pretend this is volume here. This diminishes rapidly, which shows that supply is drying up, that stock has been absorbed by strong hands. And I'm going to show you a real life example of this in a minute. And so as this happens, the other thing that you see is in the spread of price and the volume is the spread of price starts to really compress. it diminishes. So you can see that volatility is coming out of the stock as it's trading in this trading range. And then oftentimes you either get a spring here, which is a slight break to a new low, or you get a what's called a last point of support over here. And this is the final test before the uptrend begins. Now, the uptrend doesn't tend to excite anybody because everybody's used to the trading range now being in force, but this is a very important uptrend. And this is where Wyckoffians get busy, because these points, the spring, the test, the last point of support, the backup, another backup here, these are the areas where we're putting positions on, because we're seeing that now the composite operator types have pretty much wrapped up most of the available stock, and the stock is in strong hands. It's hard to buy. Large institutions that want to own the stock are having trouble buying enough shares, because every little purchase that they make drives the stock up easily and effortlessly up to resistance. And what happens with many trader types is that they try to short this because they're at the resistance level again. But in fact, this resistance is short-lived and the new uptrend begins. So phase C is the final testing. Phase D is the rally up to the resistance area in the beginning of a new important uptrend. Phase E is the uptrend. The price is escaping the accumulation area and beginning a new, robust, important long-term uptrend. So, covered a lot on this slide. This is just a different variation of the same thing, but this is what we're training ourselves to see in the chart. So let's look at a real life example. So here's Netflix back in 2012. And I just want to demonstrate here very quickly that the CEO is at work. And as I recall, this was a chart I did for ChartCon. You can see here a hedge fund manager reported in Dealbook that he had cut his stake by almost half, or by half to 4.5% of the floating shares. This is one hedge fund. One hedge fund had 9% ownership of all the floating shares of Netflix. And they cut their position in half. So imagine if they were competing with a number of other big hedge funds that also wanted to own Netflix, that they all are competing to own these shares in this accumulation area. So here you can see there's an accumulation: climax, automatic rally, resistance, support, and then a spring here, which produces a phase C low, and then phase D is a rally up to resistance, and then phase E is the beginning of the new uptrend. This is actually monthly bars over here on the right, and you can see that once getting out of this area here, look at the uptrend. Well, they had bought their shares at $58 a share and sold half at $314, which is where this arrow is right here. So and they kept half their position, 4.5% of the company, which produced much higher prices. And so here, this green line down here represents the average price that the CEO, in this case, this hedge fund, had bought shares at, which you can see is pretty skillful purchasing of these shares at $58. They actually were able to get their entire position on under the support line. We like to think of CO types accumulating their shares and getting about average price for the middle of the trading range, of the accumulation range. That's their goal, is to be able to have an average price throughout this in their accumulation of about the midpoint. And look at where this hedge fund bought. This was incredible skill. So I'm just demonstrating the mind of the composite operator and how it works. And we want to be thinking like them. We want to be acting in concert with them. We can do that by how we look at the charts.
Hey, Bruce.
Yeah.
A question on that last chart that you had up there. If you're trying to buy on that spring, or you're starting to accumulate on that spring, would you then also keep a tight stop beneath that, or would you think that if it goes down one more time, it could be another spring? How do you manage the sell side if things don't work out the way you think it's going to?
Sure. There's a number of, Wyckoffians all act a little bit differently from each other in the way that they do their entry tactics. So typically what we suggest is that a Wyckoffian strategy would be to start buying on the spring, but buying in tranches. So think in terms of thirds or quarters. So a 1/3 purchase on the spring, because the spring is a very important point, because this is where the trade is going to do or die, most likely. And so stops go below the spring by some minor amount, because of this. And you don't buy the spring, you typically buy the test of the spring, which is the first higher low. And I try to identify a higher low there, which this is a small test, but there's also another test, which is that LPS area there. And so either one of those represents a great entry place. If you buy on the LPS, last point of support, stop goes below the spring. And these are very good tactical places to put stops, because if stock is in strong hands, it can't get back to that lower level. It's just very difficult to do because the stock has been absorbed.
Okay, and there was
yes, always using stops.
Okay, there was one other question, and the question was looking for the main advantage of the Wyckoff method. Are you trying to catch a particular wave, or are you leaving a stock alone because the waves aren't over yet? I mean, it kind of. I think you mentioned Elliott wave earlier. So is Elliott wave kind of part of this, where it looks like the waves have ended and now you're starting to turn back up?
Yeah, Elliott wave is not technically a part of the Wyckoff method, and not that Elliott wave doesn't have its benefits, but notice what we're doing here on this chart. There's a spring and a test, so you buy the test of the spring, stop below the spring, then you buy the LPS, or somewhere in maybe the turn off the LPS as strength is starting to show up. You're buying there. There's another LPS towards the top of the range where there's a little bit of a kind of a short-term shakeout, and then the LPS turns up and goes out of the trading range. And then there's a backup where it pulls back to the resistance area. All of those are buyable areas. So each one of those could be a place to add to a position on a rising scale at higher prices. So the key is to be buying the emerging uptrend.
Okay.
So
there's actually one more question. If you
Sure.
were finished with that point, are you finished
Sure,
with that point?
Sure. Mm-hmm.
Okay. A question just came in, and this one is interesting because I was thinking the exact same thing. With this example, earnings had a tie-in with that LPS and other points. So
Right.
number one, do you factor earnings into your analysis? And number two, and the question that I had for you was, do you find a lot of times that you get these character changes on the charts with earnings? Like the market is anticipating, that it's going to continue going down, and then you get maybe funds or hedge funds, different investment firms and so forth that have been out managing or meeting with management, who are now thinking, hey, you know what, things are starting to look up, and they start accumulating, and then all of a sudden you get that earnings report that comes out. How do the earnings factor into the way you approach Wyckoff?
Well, the earnings are very important in my thinking, because my preference is to always buy stocks that are showing good sales and earnings growth. And you can find them where the sales and the earnings are turning before the accumulation is complete. You can see this, you can find it all the time. So I think that sales and earnings are important because they propel stock prices up and show you have a turnaround situation. And that's my preference.
Okay.
But also take a cyclical stock, say like a Caterpillar or Deere, where they have very cyclical business models. And those stocks can have accumulation begin and bases build while the news is bad. And so the news is negative, maybe the company's losing money quarter to quarter, and the stock is showing classic signs of accumulation. That often happens in cyclical type stocks. And so and then what happens is as the stock emerges out of the accumulation range, you start to get better news. So the stock is discounting better news coming.
Okay.
So that's something that I see often.
Awesome. All right, thanks.
Okay. All right. So here I'm just putting this chart up because I'm not even keeping track of the time, but so here, this is the classic places for entry. And so I just put these in the accumulation area. Now there's a whole nother approach to entering stocks, which is on the uptrend, and Wyckoff has beautiful classic rules for trend line analysis and trend channel analysis, which is really helpful in terms of buying stocks in an uptrend. Wyckoff is all about buying stocks when they're strong, they're outperforming, they're best in class, their leadership. This is a big part of what he was a proponent of. And very early on, this is 100 years ago, so it's like it's still true today. But here we have this idea of the backup, we have the spring, we have LPS, we have backup, and then we have what's called jump the creek, which is to jump out of the accumulation area and then start to really go. And so that's a great place to initiate also. These are all places to initiate, but you can see they're all in the uptrend. And so this is something we work really hard on, is develop our skills at being able to buy strong markets in uptrends as accumulations are concluding. So this is a skill that we really work on. Okay, so here's another example of this. I like this chart because here's the spring and the test. What I really like about this chart, and I'm not gonna spend much time on it, but look at the launch. This is often what happens, is that you get this remarkable launch, which shows that the stock is deeply held by strong hands, and it takes very little additional demand to just launch a stock out of its accumulation area. And ironically, this is when a lot of people are trying to short the stock, is right in here. They're like, oh, it's back up to the resistance area, let's short it, and then they just get crushed. And so, and we're looking at this and going, oh, this is the beginning of something really important. Okay, so let's do this example. And Tom and I did this in real time on Market Watchers Live way back when. So this was back in early 2018. And so I thought this would be a fun one for us to put up, because this is a real life example of a stock that we did in real time on Market Watchers. And actually I had a position in it at the time. And look, so here it is, selling Climax, automatic rally, support under the selling Climax, resistance over the automatic rally, sets the outer bounds of the range for the foreseeable future. Well, look at how long this took. This was early 2016. So look at phase B. Phase B went from late March of 2016 all the way up to late July of 2017. And look at how there's just this aimless trading, which we talked about. Look at the volume come in. Look at all this volume. There's right off the peak, supply is present. So that declines easily, volume does dry up, that's constructive. And here there's less volume as it goes down. And also notice this decline is less than this decline, and it takes longer. And then right at the end, there's a big whoosh down into support. But look at the volume come in. Well, the volume came in on the lows, right here at the lows. Well, who is that showing up and buying stock on the decline into the support area near the lows? I can hear you all out there, composite operator. So there's a whole group of people that are in here systematically accumulating shares in the bottom half of the range as prices drop. So you can see now, look at here. Look at the difference in this decline from the prior. The volume is quite low, and I put a green arrow there. Volume is quite low, which shows that even though prices move easily downward, volume is not anywhere near as intense as it was in the prior kickoff of the prior declines. And so then we come down into, this is a case, this is an LPS, does not make a new low, but it went right to it. But look at the spread, narrow and narrow and narrow, and there's no volume, very little volume as it pushes down into that support area, which is a sign that the stock is exhausted, tired of going down. There's no additional supply present, and then it turns. Now here, look at this test. There's one bar here where there's a big wide bar. It goes down deeply, doesn't get to the prior low, and then closes near the top of the range. That's a great day. This is a week actually, great week to buy right there. And so look what happens. Look at this rally. See, you're all developing an eye for this now. Look at how there's just a persistency of this advance right up into the midpoint of the range, and then look at this acceleration up into what we call a sign of strength. So this is just a really important event which takes the stock, Shake Shack, up and out of the accumulation area briefly, but notice that it is able to get above all of the prior resistance, all the prior peaks, all the way through the accumulation area before it comes back in. Comes back in about halfway, not uncommon. We call this another LPS. This is a great place to buy stock. And for the turn, and you could wait till you get that first turn up, but look at it, this tight little range bar here. Look at all the volume. All this volume comes in right at the end of the decline. Who's that showing up and buying stock at higher prices? It's a CO. And then you have this nice turn up. This is the beginning of phase E, and phase E is the new uptrend. And so here is just, and this happens over and over and over. And so let me just put this graphic up. So why is it, first of all, Shake Shack is in the downtrend because it's in weak hands. Look at the volatility as it's going down. Look at the extreme ranges in the decline. Look at the volume that shows up. This is a stock that is in weak hands. We do not want to get in front of that. We watch it intently, but we do not want to try to buy that decline because we're just going to get ripped up.
Hey, Bruce,
so,
looking at this chart, coming off of that last LPS, or actually the one in September, yeah, right there. So coming from that low, moving higher. Now I'm a candlestick fan, and I'm looking at all these candles, and they're all hollow candles, which means that they are closing above the open. So that, to me, is another sign of accumulation, seeing all of those hollow candles. I know you use candlestick charts.
Oh, yeah, I love them.
How big of, how big is it for Wyckoffians to use candlesticks in terms of visualizing what's taking place?
Well, as you can imagine, Wyckoff himself did not use candles because they hadn't been invented yet, as far as I know. He used regular, just, we call these vertical bar charts. He used just a regular open, high, low, close, or high, low, close vertical bars. and he was able to do quite remarkable analysis just with that. But I think candles just reveal so much.
Yeah, I would agree. I would agree with you.
Yeah, I love candles, and so I do everything in candlesticks for the blog and for the videos and stuff. But I think that you can look, and I think your point is so good, because like, see, all of this is just, you know, really good demand coming in and pushing the stock up. And here's another important thing. So here, look at these two big bars. Probably came on news, but it took it up and out of the range, and then it came back one time to the middle, and that was it. And then look at how easily it's able to, Shake Shack is able to just move right back up out of this area. And this would be a classic place to put another position on.
Yeah, and I can confirm, by the way, I remember you coming in on the Market Watchers Live and specifically talking about Shake Shack when it was kind of in that right side where it was starting to turn back up, which is what
Right.
you talk about that you look for. And that was very, very early. I don't remember if it was toward the end where it made that big breakout, say in April of 2018, or whether it was in the LPS, but I know it was fairly low compared to where Shake Shack ended up going to. So that was a real-time confirmation of how you can use Wyckoff to kind of visualize what's taking place on the chart.
This is it's a fun case study, and just such a good example. And then the other thing I would say, and I really remember that, that was just a great session that we did. I think it might have been one of my early sessions at Market Watchers with you and Aaron, but it was fun. But I put this graphic on later. I didn't have this at the time, but this is the notion of who holds the stock. This is really the big thing that we're working on. Who owns and holds the stock? Stock's in weak hands at the bottom. Stock is getting systematically accumulated by the composite operator. Think of the composite operator as building a position in a stock that they're going to hold a long time. So they're going to wrap, if one hedge fund can wrap up 9% of Netflix, just think what a few of them can do. And when they wrap up those shares, they take them down in the basement, this is just symbolically, they put them in their vault, and then they lock the vault, and they go, I'm not taking these shares out of this vault for a long, long time until the stock is much, much higher. And so the stock becomes scarce. It's hard to buy. This is supply and demand. And so the supply at the left side is high because it's in weak hands, and the weak hands are in pain. The stock on the right side is in strong hands. It's been absorbed, we call it, under accumulation, hard to buy now. Institutions that want to own this stock are going to have to pay up, and that's what causes these bars to look so robustly bullish as they go up out of the accumulation area, because supply and demand is such that the stock is dear, difficult to buy as it jumps up and out. Now, so here, another graphic. So now stock is in strong hands. Once it's in strong hands, then it can begin its important uptrend, because there's no stock left to buy. It's all been absorbed. That doesn't mean we can't go in and move along and ride along with the composite operator as they start the uptrend, because we can buy the shares that we need, but they can't. So here is the completion of this accumulation process, and this is the thing that I want you to be aware of as a central part of why Wyckoff thinks the way he did, and rationalized how charts work and how markets work. It's all about who owns what, and whether or not.
Well, go ahead, finish.
No, go.
I was just looking at this and thinking about the whole market maker structure of our markets. And, for those maybe who don't follow the market very closely, if you have a pension fund or you have a hedge fund or whatever, and they want to build a position, you have market makers that actually have these institutional clients. So the institutions will go to the market makers and say, I want to buy 1 million shares of this company. Well, market maker doesn't take a order like that and just put a market order out for 1 million shares.
Right.
Their job is to try to get the best price they can for their institutional clients.
And these
And
are
if
their
they
best customers.
Exactly. And that's
Yeah.
where they're making all their money from.
Right.
So I think, and correct me if you think I'm wrong, Bruce, but I think when you go through these periods from weak hands to strong hands, this is when the market makers are kind of doing their business for their institutional clients, accumulating, and you were talking about COs, and I think that's kind of what you're referring to, but the market makers are using some of the short-term downtrends to scare people out of their positions. When you get those springs, like you get that false breakdown you showed earlier, there's a lot of traders that'll look at that and say, oh, I got to get out. So they automatically will put their stop in and they get stopped out just as market makers are accumulating more shares for those institutional clients. And then once all of that takes place, as you've illustrated here, I think that's what you're referring to. Now you've got money in the strong hands. All that supply has been absorbed, and now the stock, when it makes that breakout, you get technical traders wanting to buy it. There's really not a whole lot of supply out there. Is that, in a
Tom,
nutshell, how it works?
You said it better than I could have ever said it. It's like,
I don't know about that.
Perfect. No, perfect. Exactly right. And the thing is, the only thing you said this, I'm just going to say it again for emphasis, is the CO types buy on a scale down in the range. They want to buy weakness because they don't want to put the stock up on themselves. They're buying so much that they want to use the impending weakness. So when the stock is going up, they're not putting in orders. And so they don't want the stock going up on them. They wait until they can buy on a scale down towards support. And they do this methodically. And so all of these are the zones where they're doing the majority of their work and trying to get that average price in the middle of the range or lower. Look at how it came right down to their average price at the backup and then turned up. They're very careful about what they do, and they know exactly what they're doing.
Question here that just came in. Can you talk to December 24th, 2018 in terms of Wyckoff? So December 24th, 2018.
That was well, let's see, I don't know. I'll tell you what, I have sorry.
I think that was right when the market bottomed.
That was right when the market bottomed.
Yeah.
And I have point and figure charts that I did this week with Roman Bogomazov for power charting TV that you can see starting today at 3 o'clock Eastern. And I do the point and figure charts I did in real time off the distributional peak, and they make beautiful counts into the low of the climax. And then I do a point and figure analysis of the accumulation area in that climax, which I published as a blog on January 9th of 2019. So go see those. Those are real-time charts. And you'll be able to see the process or the thinking and how accumulation fully formed in a very short period of time for the important move up we had in 2019. And as of this week, I'll just say this, as of this week, the point figure charts I made in January of 2019 are fulfilling. They're now in the zone of fulfilling their counts, which is coming right at the end of the year. And this is what I'm going to talk about in Market Vision 2020, is now that we've used up the fuel in the base count on point and figure, what's up for 2020? What's likely to happen?
Yeah. Okay. Question for you. This particular example on Shake Shack, you can see that it took a long time. I mean, we're talking years for this whole process to play out before we saw another big move up in Shake Shack. Right. But what do you do with a stock? And I guess the easy question is, which time frames can you use with Wyckoff? Is this something that you really should only do on a weekly chart? Can you do it on a daily? Can you do it on an hourly?
Let me answer that question with a chart. Okay. This is the comp. This is an accumulation area that I did, and I actually published this. If you look here, I put down the source. You can go right to my blog and look at these charts. They're there in the archives. Excuse me. But here's a big accumulation area. Well, look at this. This is a 2-hour chart. So this is intraday data. 2-hour chart builds this count that goes from January of 2016 to March of 2016. And so you can see these are the count areas. So you always take the count areas for point and figure off of the vertical bar chart. So here's 3 count areas that I took. So here's the first count. I'm gonna do this really fast because I know I'm running out of time. So here's this area right here. So this is a 30-minute chart. So now think of it, if you're a swing trader or you're a short-term trader, and I do these charts all the time in webinars and so on, because I want to point out that this works intraday as well as works on daily and long-term, like Shake Shack, which took multiple years. Well, this is intraday data. This count right here, look at this, gave us a count right to this zone right here, 46.78, 47.55 on the NASDAQ comp from a count line of 42.15. So great trade. Then, but that's just that tiny little count at the bottom. So here's the next count, which is this area right here. And so this count I took, and I took 2 counts, which I often do, 5,500 to 5701, and then the larger count, 5767, 5968. And also just make a note of this distribution count. Look how beautifully it worked. Okay, so now this count, so this count went up to this area. So I'm going to ask you just to remember these numbers, and I'll show you how this turned out. Then here's the count that we did of the whole shebang all the way across. And this count goes 60.52, let's call it up to 64.61. You can't see that here, but look, the count line is 45.97. I think I have that right. Anyway, so there's our maximum count of this area. Okay, well, this is a weekly chart of the comp back in 2016. This is the area that we just analyzed. And I know I did this really fast. These are the count ranges of these counts here, here, and here. And look at how beautifully this all worked out. It got us right up to this, what we call a reaccumulation area. But look, there was a bigger count that we couldn't even see in the intraday data that went all the way across. And this count took us up to, look where it took us, 7,400, 8,300. Well, look at where the market stopped going up in 2018, right into the count for this whole reaccumulation range right here. It stopped right in here, and it needed a big pause, and look at the pause that we've had. So I intend in Market Vision 2020 to analyze this whole area, not only on the comp, but also on the S&P or the Dow. I've already done this actually, but I'm going to do point and figure analysis of this whole area, because look at how easily and effortlessly we're moving up and out of here now. This looks like absorption is complete. The markup has begun. We're up and out. So the question is, what happens now as we go into the new year? Is it sideways for a while and then up, or do we just keep going? And then what is the potential objective that we get? Because this objective, not only did we get very cool trading counts down here in this little area at the bottom, which gave us really good trading, swing trading counts on an intraday basis, but then on the daily chart, we got counts that took us right up to where the comp had to stop and rest for 2 years. So the thing I want to do, so hopefully that sort of answers the question. I can't get into today how to do point figure counting. We spent almost a whole semester on how to do point figure counting, but I want to give you resources, because this is a tool like none other. I think point figure analysis is so special and nobody does it. It's as old as time. And there's evidence of horizontal point figure counting methodology that goes back in Japan in commodity trading back 500-600 years. But very few people do it today. And it's a little cumbersome. So people just sort of don't do it. But let me give you a resource. If you go to Wyckoff Trading Method, which is the trading channel on YouTube, that I post up some resources, and also all of my Stock Charts TV shows are on this channel, as well as on the Stock Charts TV channel. But go to this, and this is going to give you a great two-part tutorial, 2 30-minute parts on how to construct Wyckoff point and figure. And so go there to learn more about how to do it.
Yeah, I also want to say, you know, in addition to having Bruce on with me at Market Watchers Live for a couple of years, we also had a regular guest, your partner, Roman Bogomazov, who would come in and also share information on Wyckoff. And I'm telling you, after watching it for a while, it really is powerful. And I think you could sense one of the questions in the room, Bruce, because there was a question asking if there were some other ways to learn about Wyckoff. So you hit that perfectly. 2 more questions, and then we probably should be wrapping up. One question is, well, actually, both these questions. What's that?
No, I'm just laughing. It's like, do we have to wrap up? It's like, I'm just getting started.
I know. There were 2 questions, and I have a feeling you're going to answer both of these at Market Vision 2020, but I'm going to ask them anyway.
Sure.
One was, how does Wyckoff account for V-type recoveries? And I think kind of the one we had at the end of 2018 is a perfect example, and you said you were going to talk about that.
I am going to talk about it, and if you want to see my analysis, which I did on January 9th of 2019 of a completed accumulation, you can go back to my blog from January 9th of 2019 to see that chart and the point figure count. And then also I review it in my 2019 review in Stock Charts TV, my power charting show. And so you can go right there and watch it on YouTube, which you can get to right from stockcharts.com.
Isn't technical analysis a wonderful thing?
Oh my gosh, it's so much fun.
I mean, in January, you're talking about a year ago, having put up all the stuff and showing, you know, based on your analysis where we're going now. If you'd gone in and just turned on CNBC, you'd have been scared out of your mind back in early January of 2019. But, you know, I know you were writing about, you know, the fact that we were going to go higher. I was looking at it, I know, back right around the lows. I mean, I was so disgusted with the Fed and what the Fed was doing, because the market was telling us, the stock market was telling us, and the bond market was telling us that we were experiencing a slowdown. And Q4 GDP for 2018 ended up coming in much less than what was previously expected, and much lower than all the other quarters in 2018. And all the Fed, or all the markets were looking for, was the Fed to turn from being hawkish to dovish. That's honestly, I think that's all they wanted, was to know that the Fed was there to support the markets in the event that we had the slowdown due to the trade war and so forth. And it took the Fed almost entire 2019 to finally figure out where they needed to be. And I'm not going to go on that rant, because I've been on that rant plenty of times. But again, it's technical analysis. It's what you're looking at, Bruce. It's what we're looking at. And I'm telling you, folks, Market Vision 2020, you don't want to miss it. You've got some of the best technical minds coming together, giving you their forecast for 2020. And I'm really anxious to see what these point and figures tell you, Bruce. You kind of teased me. You teased me when we talked last time, and you said 20, and I'm going to tease everybody else in here, because you told me that 2020 was going to be the tale of 2 markets, and you wouldn't tell me which half was going to be which. so now
yeah, I can't tell you. I'm sworn to secrecy until January 4th.
Yeah, I know.
But it's so fascinating, and I'm very excited to talk about this. And I'm going to do some big mega mondo point and figure counts that show us some possibilities for what could happen with the markets. And even though there's going to be bumps along the way, and 2020 isn't going to be like 2019, I think that there's the potential for some good things to happen later on. And so we just want to be patient and wait for those opportunities. I'm going to talk about that, how to do that.
Yep. And that other question, the one was about the V-type recoveries, and we're going to finish on this one. The other one is, can Wyckoff be used with an index like the S&P 500 that doesn't have volume? And I know with the point and figure you were just talking about, that doesn't have anything to do with volume, correct?
No, but it's interesting. At stockcharts.com, you can put volume on point and figure charts, and it's pretty cool stuff.
Okay. I didn't know
so that's something for a future episode.
Okay. Well, this has been very enlightening. I think for those who maybe are new to Wyckoff, I think this is a really great initial view of, how you approach the market using Wyckoff. I just know from my background and the way I look at the market, I think the Wyckoffian approach it's just common sense to me.
It's best practices.
Yeah.
And what Wyckoff did is he found a way to express it in a way that we could create a logical sequential methodology out of it.
Yep.
And we can look at charts. We can see a number of different charts that are all maybe under accumulation and be able to they all have different looks, but we can draw the same conclusions based on how they're unfolding.
Yep.
So that's I think very exciting. It's not pattern recognition, it's behavioral recognition.
Yep. Definitely a little different approach, but still similar. And I just love stock market really is all about supply and demand, and the way you lay it out and the way it's laid out with Wyckoff is simply looking at supply and demand and realizing when you have the advantage to get into a particular stock. So the market overall.
Wyckoff had 3 laws: cause and effect, effort and result, supply and demand. And that all these 3 laws drove prices up and down. And so every one of the things we talked about today had its basis in those 3 sets of laws, which is another thing that we can talk about in the future. And but supply and demand is a cornerstone, an absolute essential part of being successful in markets, is knowing what the balance is between those.
Excellent. All right. Well, I see up on the screen, you've got you and Mary Ellen. I did not realize that you two were going to be working together on something. So this is pretty exciting. And of course, we had Mary Ellen on here. She did the first mini-series event, I don't know, probably a month or so ago. And that was really fascinating. So I think it's kind of interesting to see the two of you putting your, collective minds together. What's this all about? I'll give you a minute to.
She's such a great stock picker. She's so good at what she does. And I'm honored to be working with her. We're going to co-edit this high growth income monthly report. And the idea of it is that the importance of growing wealth with income is essential, and that growth, even though it's important, it's unpredictable, where income is much more predictable. And we can show study after study of how stocks grow their income through higher dividends over time. That helps to propel the stock price higher. And the combination of those two things is a compounding wonder thing, and to have those working together in creating wealth is really important. And I'm going to be doing a lot of point and figure work on these stocks that we're selecting as the best stocks for growth and income over time. So we're really excited about this.
That's awesome. And I've worked with both of you really closely, and I'm sure that's going to be a great service. And you said you said earlier, I think that's going to be starting soon, but anybody who's interested can send you an email, right?
Right. There's the email. Send me an email, and we'll make sure that you're notified as things get rolling, which will be very soon.
Awesome. Well, I tell you what, my friend, I am looking so forward to Market Vision 2020, and I think I'd have to go back and look at the schedule, but I think you and I wrap up. I think we're the last 2 presentations, so I've got to follow your presentation, which I maybe I might call for an extra hour to regroup.
Tom, stop it. you're among the best. So I think I'm lucky that I get to go first. So,
well, thank you for that. Checks in the mail.
yeah. Well, anyway, we've had a lot of fun doing this, and I hope we get to do a lot more.
Yeah, we will. But thanks again. I do want to thank you for taking time out of your day to come out here and, to explain all of this to folks who are probably, a lot of them are new to Wyckoff. So certainly enjoyed having you. Really appreciate it. Look forward to seeing you on Saturday, January 4th.
Thank you all. Thanks. Appreciate being here.
All right. Anybody wanting to go to the Market Vision 2020, one last thing, EarningsBeats.com, go in, click on the tab at the top, Market Vision 2020. Again, that's at EarningsBeats.com, Market Vision 2020 tab, and you can register there. Everybody have a great day, and hope you enjoyed the presentation. Happy trading.